Good afternoon. This is Tom Alexander. It is Sunday, May 19th. It is about 10:45 a.m. Eastern Time in beautiful Charleston, South Carolina. This is the weekend stock market update that I do every weekend. I send out a notification and a free report. If you are not on that list, if you are not getting those reports and other free stuff that I send, shoot me an email, tom@alexandertrading.com. I'll put you on the list. Also, if you find value in this, it is very helpful and very much appreciated if you will like the video and if you will subscribe to the channel. Also, now let's discuss the market for just a second here in broad-based terms. The trend is up. The trend is up in all time frames. There is no sign of a significant top. The market is likely to continue higher. That's what you need to know. Now, could we top out in Globex? Could we have topped out at Top Tick on Friday? Anything can happen, but there's a lot of evidence that I'm going to share with you that's objective, that doesn't involve magic, that suggests that the market is trading higher and that any short-term top in here is just that. It's a short-term top. So that is the weight of the evidence. Let's take a look at the chart and let me see if we can back that up. Now, the first thing I want to show you here is the website. So this is where you can go to get free weekly updates. You can also, so just go to alexandertrading.com, click on weekly update. And what you will see the updates. I did a special midweek update this past week, but every weekend, at least every weekend, and then occasionally more often I will do, or occasionally less often, but occasionally I will do a midweek update when something dramatic occurs or something that may have changed the opinion given in the weekend report. But this will give you a chance. If you click on these, you can go back and you can see, first of all, you can get a PDF of all the charts that I'm going to show you today. And you can print those out, you can study them, you can have them for future reference without having to access this video. And then you see the charts, a few comments that I make, and you can go back and you can see for yourself and test the veracity of the comments that I'm making on a week-to-week basis and see if this is something you may want to look more deeply into as far as both a way to analyze markets and also to help you with your strategy and your tactics in terms of practical trading implications. Okay, so enough. Let's look at the actual charts. Now, there's really a lot of stuff I want to show this week, but the bottom line again, and this is what's most important, the trend of the market is up, and it's up in all time frames, from intraday, 5-minute charts, 30-minute charts, whatever time frame you want to use, the trend is up. Now, the tendency among the vast majority of traders is to want to fade everything. So everybody wants to be calling the top in here. Okay, and if you're calling the top, well, what are you calling the top of, and why? So if you can't answer that question, just go with the trend, which is always the best advice. You want to be trading with the trend. So I'm going to go through each of these indices very quickly and point out the immediate key reference areas, the immediate inflection points. I do not like to use the term support and resistance because support can you can fall through the floor, and resistance you can blow through the top. But there are levels in the market that the market establishes itself through the auction process that are inflection points. So with that said, here we have the S&P. There's nothing above Thursday's high, okay? There's no quote-unquote resistance from an objective perspective. What's an objective perspective? Something that has occurred among market participants. Nothing has occurred among market participants above Friday's high. So we have no idea where the market could stop. Now, there'll be 7,000 ways to project exactly where this thing is going to turn. And you can go to Twitter and you can find all those. You'll have Gann, you'll have Elliott Wave, you'll have Fibonacci, you'll have all sorts of things. Gurus come out of the woodwork whenever the market is making intermediate term highs and lows. The predictors come out of the woodwork, but that's not the way you trade. You trade with identifying the trend and then trading in the direction of the trend. And that's true in any time frame you're trading. So immediately, the immediate downside key reference area is going to be Friday's cash session low. Now, this is the SPX. You can extrapolate this out to the futures, but the cash market is really the dog. The futures are the tail. The futures incorporate a lot of noise in Globex, et cetera. So I use SPX in my analysis for my futures trading. All right, so the downside key reference area, the immediate one is Thursday's low. The upper is, Friday's low. The upper is Thursday's high. Now you can see we've gone a long way in 10 trading days. We're up 6%. That doesn't mean we're not going higher. It does have implications for the rate of change, though, and we'll get into that. And another reason that we're expecting the rate of change to transition into a different market condition in just a minute. But as far as the SPX is concerned, here are your key reference areas. And then we look at the NDX. And again, you can see this on the website. You can download a PDF off of the website that will give you these levels. But here are the levels in each of the indices. Here's the NDX, the primary indices. Here is the Dow. Here is the Russell. Now, the Russell is the one that is lagging, okay? The Russell is just lagging. This is not an all-time high. This is a multi-year high. An all-time high is way above this level. But in general, as you can see, on an intermediate term basis, the Russell is moving in the same direction as the other four primary indices. Now, another index that I think is important to make note of is the New York Composite, because it's every stock listed on the New York Stock Exchange. So it's the broadest of the indices that I've been showing, and it is also confirming the higher move. Now, the fact that we have 4 out of the 5 primary indices making new all-time highs, and the Russell is being a laggard, and there are good fundamental reasons for that, as we all know. Ultimately, that may matter, but the other indices can be up 10 or 15% from here before it matters. So in that case, it's moot. It's not helpful information. But the fact that all the other 4 primary indices, besides the Russell, are making new all-time highs makes it extremely likely that there is no top of significance close. Now, that does not mean that we're not going to see a more rotational market. As a matter of fact, I think that we are on the cusp of very soon beginning to see a more rotational market. So what does a more rotational market mean, you ask? Well, let's segue into something else I want to show. There are a couple of things here. Let's just start with the profile view. Let's see now. And all right, what you see here, this is the market profile view of each monthly auction. In other words, each profile unit here is 1 month of trade. We are only halfway through, really, the May auction, and you can see how vertical it is. You can also see it has a rather funky structure. At this point, there is no pronounced area of volume. And even in vertical auctions, you can go back and yourself and look at your profile charts. And even when the market is extremely vertical, you will have areas of overlap in price, and that's indicating value within that auction. We don't have that yet. We still have a market that is probing for value. So you can say that in the auction process, there are 3 steps of development, a trend, stopping price, and then development around that price. We're still in step 1, really, in the May auction. If we split this out, you can see we've basically been vertical since the beginning of May. At some point, that changes and the trend begins to slow, and you see more development, you see more overlap in price on a day-to-day basis. So this is part of that objective evidence that I promised earlier about why I think we're on the cusp of a change in market condition, not a change in trend, a change in market condition. You cannot trade all market conditions the same. Now, the trend can be strongly up and you're favoring longs, or the trend can be higher, but in a grinding fashion, and you can still be favoring longs, but you trade those different strategically and tactically. And it's important for a trader to understand that. And that's the benefit of this type of analysis. It's the benefit of understanding auction market principles and viewing your tools, market profile, the graphs you use, whether it's a bar chart or candlestick chart, through that lens. Okay, let's take a look now at this page, the internals. Okay, I'm going to come back to this. This is a very important view at the moment. Let me find. Okay, this is NYSE data that I use. I use very simple things. I use market generated data. I use NYSE advancing, declining issues in particular. It is highly correlated. If you ask why don't I use advancing, declining volume? Because it's essentially the same thing. The correlations between advancing issues, declining issues, advancing volume, declining volume is almost perfect. Not quite, but very, very close. So anyway, so the red line here is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of advancing issues. The histogram is breadth itself. Now we've turned down from reaching a peak in the 10-day moving average of advancing issues. Now, the actual reading of this peak is as high as it's been in a couple of years. And that's not as important as the fact that it seems to have identified itself as a peak and it's turned lower. Now, what follows? Well, it depends, okay? You can have an almost immediate top of significance as we had here. Now, the market did go higher for a few days following this peak in the 10-day moving average, but it rolled over and then we had an intermediate term decline that was a chop fest into the low that we had last October. Or it could be marking a short-term top, a very short-term top, as it did at the end of December. Or it could really just continue to grind higher as it did following that top. We had a bit of a contraction in breadth and very little price damage. But then, as you can see over here, the market went higher. So you may ask yourself, well, is this, so what? This doesn't help me. Well, actually, it does help you. It's not necessarily calling for a top, but it's further confirmation that market condition has changed. The condition of going higher has changed. So we can go higher and have different conditions within that trend. And that's where I think we are. And that's what I think is most important from a trading perspective. Now let's take another look. And let me find it here. It's the chart I just wanted to show. Let me do this. Where is that? This is what happens when, here we go. Okay, now what you see here, this is the SPX. Now this is 10-day average true range. This is VIX, the volatility index. Now the volatility index on Friday closed at a level that it has not closed at since 2020. Working on 4 years, 3.5 years. Now, does that mean some sort of imminent top is in place and VIX is about to scream higher? No, it doesn't. Actually, it's more likely that it is validating the idea that we are in a bull trend and the bull trend is likely to continue into the future. Okay, so what else can we take away from what we see on this chart? Well, VIX is pretty highly correlated with average true range. When you have a high VIX, you tend to have very high range on a day-to-day basis, 10-day moving average of volatility, of range in the market. So what this is telling us is that, yes, the trend is up. It's being confirmed by a lack of volatility, and that is likely to continue. You can see VIX, the average true range can get a whole lot lower. And it's actually likely to get a whole lot lower if my thesis is right about this market going higher from here. But it's also important, and it sort of confirms the thesis that we're going to go higher, but the rate of change to the upside is going to drop. And what that means is that we're going to get into a period. I'll go back to the cash chart just a minute. That's not so noisy. But if you go back and you study your charts and you look at these periods where average true range has dropped and then it gets in a range, and you look at VIX and where it is, and then you look at the trend in the SPX or the other indices. I'm using the SPX because it's the most followed proxy for the market among traders. You're expecting higher prices, but you're expecting the ranges to narrow. Now let's go back to the cash chart. And I want you to notice something. So how do you know when the trend is changing? Well, let's go down to a 30-minute chart. And what do you have here? You have a market that is making on the 30-minute time frame higher highs and higher lows. And until that changes, the market's going higher. Now, can you have the market take this level out, trade in here, and then go higher? Yeah, you can. No question. But if it does, then at least you have a lower high that can give you an objective lean in case you're jumping out of your skin to be short. If you want to short this market right now, your stop is above this level. That's the bottom line. That's how you use this information. That is as objective a piece of information as you can find. Now, I think the trend is higher, and I'm going to wait for more confirmation before I enter position trades or swing trades on the short side. And I'm expecting to see higher highs because we're making higher highs and higher lows. That's the bottom line. Now, something else. Let's talk about this. And this has implications regardless of the time frame you trade, whether you are a position trader, a swing trader, or a day trader. Now, if you're a day trader, understanding market condition in the large degree time frames is absolutely critical. Too many day traders simply ignore it, and they just fade every three handle move up and down all day long and get chewed into fine mush, which is part of the reason 95% plus of all day traders fail. And you may want to argue with me about that, but it's irrefutable. I'm happy to have a longer discussion with you if you want to email me, but that's just these are just facts. Okay, so what's the takeaway from my thesis that the range is going to narrow? What kind of retracements can we expect? Well, we can go back and we can look historically, right? So if we just go back to the low back in October, what do you see here? You see a market that's relentless to the upside with relatively few and very short-lived retracements that are very shallow. You had very few periods in here where you had more than 2 consecutive down days. Now you had 1 or 2, but not many. So what does that tell me? Well, as a trader, that says, well, if we're down a couple of days, I'm going to be really looking for excuses to get long as a day trader, because that's where the probabilities lie. Now, if we get if we start to break lower levels, if we see conviction within that break, if we get some sort of exogenous event and a wide range down day, that will change things. But unless that happens, this market is likely to do what it did here and grind higher. And this is not unique, this area from here to here. Go back and look at any uptrend you choose in any time frame going back decades, years, whatever. And what you will see in these strong trends is that you'll see all this volatility as the market's making a low, then you'll have a few wide range up days, and then the range begins to drop, and the day-to-day ranges get more and more narrow, and it's just a grind and a grind, a 1% drop, a grind, a 1% drop. And so that's likely to be the pattern until it's not. And I don't say that in a trite manner. How do you know when it's not? Well, you can use objective information. Again, go back to that 30-minute chart. Keep up with higher lows, higher highs on your 30-minute chart. And when that pattern breaks down, then you can start paying attention and start thinking about, maybe the trend has changed here. And it's pretty much that simple, guys. So in each uptrend will tend to have a personality. It will tend to have its own character. And an example of that, here's the low off of 2020. And we had a market that was relentlessly higher, but we had deeper retracements than we saw off of that October low into the April high of this year. But the market will identify itself. It will identify personality very quickly. This is already showing quite a relentless nature. And you can see how the trend, you can see if you look closely, how the ranges are coming in now. So what I expect to have happen, I expect to have a market that is generally going higher, and that it may go higher for weeks. It may go higher for most of the summer. Now, are we going to get retracements? Absolutely. Pay attention to your downside key reference areas. I send out reports. If I see something that upsets the apple cart here in terms of my thesis, I will shoot you a report, which is another reason, if you're not getting these reports, just send me an email, tom@alexandertrade.com. I'll put you on the list. You guys enjoy the rest of your weekend.